All right.
Perfect. Well, first of all, to start, just see if I can share my screen, and this went okay on the practice, so I'm hoping hoping this works. Perfect. So hopefully that's popped up on everyone's side. Brilliant. So before I start, I just wanted to say thank you very much for joining the call today and giving up your time. I know everyone has very busy schedules at the moment, but I thought this was a fantastic opportunity just to provide an update on the insurance market. And really, I'm grateful that we can take this chance to just give a bit of context to what's happening in the market and talk through global issues, and then work out how that's going to affect you individually as a risk in British Columbia, in this corner of Canada. So those who don't know me, I may not be a familiar face, but I'm Rory Garrett, and I work at MARSH, an insurance broker. If I go on to the next slide, I'll just quickly run through the agenda I've got set out for today. Through the presentation, please do add any questions to the chat. I've left lots of time at the end as well to talk through any questions, and happy to receive those at the end. Yeah, as Courtney mentioned, this is being recorded, just to let everyone know that. So through the session, what I'm looking to do is just provide an introduction on who MARSH is, and then provide some highlights on the insurance program we currently have, which is a MARSH and BC MPHA insurance program for social housing. I'm then going to give an update on the insurance market, and as I said, starting at a global level, and then narrowing in on specific risks for Canada and for this sector, which hopefully leads nicely on to what you can expect to see in the insurance market through 2023, and particularly with the July 1st renewals of that program on the horizon. And finally, I'm just going to give a quick overview of some of the loss control measures and risk management measures that may be of interest, just particularly from an insurance standpoint. So if I go on and start with who MARSH is. So on a big level, we're the world's largest insurance broker and risk advisor. MARSH operates in 130 countries with over 35,000 employees. Canada sits as the third largest territory that MARSH has a presence in, behind the US and the UK. And giving you that global context, I think it's very interesting when we come to some of the data and analytics, just to what we're seeing in the insurance market generally, that we have a very broad scope that we're able to pull the information from. So my role at MARSH within that is the manager of the Vancouver non-profit team. We have a team in Vancouver of 10 employees, which I'm lucky that we've got some fantastic individuals with lots of great experience there. And we oversee various insurance programs related to the non-profit sector. One of the biggest programs is the BC MPHA social housing program. My background, I've been at MARSH just over 10 years. I started in the UK, working with MARSH on their financial and professional lines area division. Within that, I specialised in finding insurance for professional service firms. Those were global firms headquartered in different countries with global footprint. I then moved to MARSH Vancouver in 2019, and I've been heading up the non-profit team since the start of this year. So I think it's key with the program I mentioned. I know some people on this call may not have MARSH as your insurance broker, and you may have your insurance through other programs. So I do hope that this provides a good context on risk profiles and what insurable risks are out there. But there will be some specifics as well around what we have in our specific program. The current program we're operating with a 1st of July renewal has over 225 social housing operators. And MARSH has been the broker on that program for over 15 years. Again, I think it can be confusing, and I think it's important to point out we are an insurance broker. We're not an insurance company ourselves. And what we're doing and our role in the marketplace is to go into the market and negotiate on your behalf with insurance companies to look for the best terms, the broadest covers at the best price point we can find. But yeah, I did just want to emphasize that we're not actually providing the insurance ourselves. We're an intermediary as the broker there. So from that, I was going to give a quick overview just of the main coverages under the BCMPHA MARSH program. So this is the 1st of July program, and as I said, I know some clients may be with different brokers here. I think, hopefully it's important to emphasize with these covers, we are the insurance broker, but once we finalize the placements, we also look to have authority where we're able to quote and bind on the insurer's behalf. This will be under set parameters, and anything that falls outside that we'd need to have sign off and check with the insurance companies. So starting on the different lines of cover, if we start with property insurance, I know this is often one of the biggest cost items, or if not the biggest cost item in insurance for social housing operators. With the property coverage, there's a panel of insurers providing the cover. So that means there's more than one insurance company, and they have differing percentages of the risk that they take on individually. There's often a lead insurer, which tends to be the insurer with the largest percentage of that risk, and they tend to set the lead terms for the program, and then any follow insurers provide that. So the property coverage is your first party coverage. So this is really covering the real operations of your companies. So the buildings, the contents. This also provides business interruption if there are any issues. This is placed on an all-risk basis and importantly includes earthquake, flood, and sewer backup coverage. So this is, as I said, one of the larger cost items and receives a lot of attention. Alongside your property coverage in the program, we also offer a boiler and machinery coverage. The reason this is separated out is that it's not covered under the property program, and again is covering first party assets, which is your own operations, and on the business interruption piece of that. Although it's called machinery, boiler and machinery, there are other examples outside boiler that are covered here. So this could be heating, ventilation, air conditioning units, or electric panels. And this is really providing cover in the event that there's machinery breakdown, and that's sudden and accidental breakdown, so either causing damage or business interruption to them. And then we move on to general liability coverage. The difference here is this is a third party coverage, and out of any of your operations, and it can be on premises or off premises, this is looking at issues caused to other parties. So the two main triggers here, a third party property damage is the first trigger, and the second trigger is third party bodily injury. So the bodily injury would be to people who aren't employees of your company. It is full third parties there, and that's same with property damage. So this isn't covered for your own property. I think it's important with general liability to always mention that a big piece of it is that it provides defence cost cover. Oh, thank you. So yeah, as I said, it's important that it also provides defence costs. So one of the key pieces is negligence under general liability. If there's an allegation of negligence, it will provide defence costs in those circumstances. We also offer crime coverage, and this is looking at employee dishonesty and really looking at any loss of funds from theft, any mysterious disappearances, robberies or counterfeit, and provides broad coverages behind those. So the crime coverage available is more to do with the employee dishonesty that arises. If we then move on to directors and officers insurance, it's important here we work with specialised insurers for this line of cover. And really the broad category here is essentially liabilities arising out of the mismanagement of the firm, as well as the directors and officers. This can include mismanagement from employees. Again, I think as well as the damages awarded or settlements paid, it's important to highlight that it would also provide cover for the defence costs. Alongside the D&O and included in it, that we also provide employment practice liability. So this can be from employment disputes from an employee that could be around unfair dismissal, harassment, bullying, or other such triggers in the workplace. And then the final piece under this program I was going to highlight is the volunteer accident liability. I know many operations have volunteers in a number of different contexts helping out. Where your own employees would be covered under a workers' compensation type cover, there can be gaps around that for the for volunteers working on your behalf. The accident liability is in the event that any of them are injured while working as a volunteer. And so yeah, it's important to highlight that is the cover that falls outside the workers' comp benefits that are available to direct employees. Perfect. So I'm now going to move on to another form of cover that's available, and this is slightly different. Rather than being a cover for the social housing operators, Marsh also has an arrangement where we can offer tenants insurance. This has been set up with Intact Insurance, so I've got their logo nice and big there. This is available to the individual tenants and at a very reasonable premium, which is $150 a year, and this can be paid in monthly instalments of $12.50. Really, this is covering the contents of those tenants for any losses, and the losses could be caused from fire, smoke damage, water, vandalism, or theft. And it's important to highlight that the tenant's own possessions wouldn't be covered under the operator's property policy. We then also show that there's liability cover, and this is the protection if tenants cause damage to the premises or anyone else's property there. And the starting point on that insurance is $1 million of limit. And helpfully, if there is damage and they need to move elsewhere or assistance, the insurance provides additional living expenses. This insurance actually runs through a different team at Marsh, but I'm very happy to share the contact details afterwards, and there's further details available on the BCMPHA website as well. and Marsh can assist with there. They provide a series of brochures to help advertise this, and it's a very simple sign up form where tenants can complete the application online and quickly obtain the quote, and if wanted, bind it through the portal. Right. So that was a very quick and brief overview of the various covers through the program, and from there, what I was going to lead on to is an update on the insurance market. And as I said, I started at a very broad global level and linked down to the specifics of the social housing sector and British Columbia. So every quarter, Marsh releases a global insurance market index. This is a collection of Marsh's data globally, and this is really where the strength of our global reach comes into play, where we can start to get some really powerful data from this. On a very broad global level, starting with Q4 of 2022, which is the last full report to be released. So after we hit the 1st of April, we'll start collating data for the first quarter of 2023. So the most recent report is Q4 of 2022. Globally, the general price increase is a 4% rate increase. With some background, that's the 21st consecutive quarter of pricing increases. So it's been a long run of price increases for insurers purchasing insurance. It's important as well that this pricing increase is based off their previous renewals. So if in 2021 they received a pricing increase, this is an additional increase on top of that. I think the 4% we see, while it's still an increase, is a lot lower than some of the highs we've seen over the last few years. And the peak of the pricing increase globally was Q4 of 2020, where that peak was 22% pricing increase. I do think some of the figure and the moderation in that figure down to 4% was driven by a 6% decrease in financial and professional lines premiums globally. So I'll start to jump into some detail on the individual lines, but without that decrease in the financial and professional lines, we would have expected that 4% to be higher through Q4 of 2022. So again, staying at the global level, but now trying to break down the insurance lines individually. So starting to split out the insurance lines into three main areas, which are property, casualty, which includes general liability, and then the financial and professional lines, which of the piece I've run through, D&O insurance would be the main contingent piece of the financial and professional lines. Globally, property insurance increased by 7%. I've just put the figure from 12 months ago that you may have seen last year, which is 8%. So it stayed fairly steady there. But interestingly, Q3 of 2022 had a 6% increase. So we have seen property premiums increasing at a quicker rate just through that last quarter. Casualty, as you can see, is a 3% rate increase, which is definitely looking steadier, and we're starting to see a little more consistency on the casualty side, and I'll come to more detail on that. And then the big change is financial and professional lines, which I think everyone will be happy to see that there's actually a pricing decrease, which is a change to what we've been seeing for the last few years there. And you can see the contrast from a year ago where we were seeing 31% rate increases for financial and professional lines, and now being a 6% rate decrease 12 months later. Before I come to the US and Canada, just for some context, the UK saw price increases at 4% in the last quarter. Continental Europe saw 6% generally. Latin America saw 7%. But then I'm sure the piece you'll have a lot more attention to is the US and Canada. This is combined pricing for both the US and Canada. And what we're seeing here is the composite pricing. So the overall pricing change is a 3% rate increase. Property insurance is the real driver of that increase at the moment, where we've seen an 11% rate increase on average through Q4 of 2022. And as you can see, again, that's actually an increase from 12 months ago when it was 7%. Alongside the property there, an interesting part is values of property are increasing, which is in addition to the rate, and the average value increase we saw for property insurance was 10% in Q4 of 2022. So any rate, as is shown there, is applied on top of the increase in values. For casualty, again, there's more stability in the US and Canada that we've seen that average as a 3% rate increase. And again, there's really good results in financial and professional lines where we've seen a 10% rate decrease. That's largely driven by some lower premiums from directors and officers insurance. So with the prices still increasing, and there have been various comments recently on receiving price increases for insurance over a number of years to understand why there's still being further increases applied. So it's helpful to just highlight some of the pressures the insurance market's receiving at the moment. And a lot of these are common to the global economy at the moment, and some of them I know very, very relevant to our businesses and our day-to-day lives, such as high inflation at the moment. So with inflation there, I know day-to-day we're seeing this in all sorts of contexts, whether that's personally each time you head out to the shops, the operations of businesses and the costs associated. But to do with insurance, the reason this is adding pressure is we're also seeing social inflation, where the costs of law firms are increasing, and we're also seeing an increase in rewards from court systems, so either jury rewards or settlement rewards increasing. So this is putting pressure on insurers as they pay out claims on those losses that a claim 3 years ago may have been settled at a lower amount and have lower legal fees. That's increased over the last few years. Natural catastrophes is again something that's hard to open a paper without reading about. Unfortunately, a disaster at the moment, and with insurers, this is hitting them particularly hard. Recently, with earthquakes, hurricanes, wildfires, and flooding. The issue that we have with natural catastrophes is there's a big aggregate exposure to lots of insurers when these come through. If there is a weather event, it can hit a certain area where insurers have to pay out losses on a number of risks from one event. With political and civil unrest, again, unfortunately, through the world, there's been a deterioration on what's going on, and insurers have to look at ways they're reacting to that. I think this is most obvious at the moment in the Ukraine, and we've quickly seen lots of insurance policies globally put on exclusions for the Ukraine, Belarus, and Russia in response to that. But the political and civil unrest again is putting pressure on insurers. The next 2 points, the supply chain challenges and pandemic impact, are not new points, and these will have been mentioned over the course of the last few years, and definitely in this presentation a year ago. But they continue to have knock-on effects and still be relevant, and continue to apply pressure to the insurers. think as well it's really worth highlighting, and this may be slightly new compared to previous insurance updates, but the pressure from the reinsurance side. And I'm going to come on to some more detail about the reinsurance, but all the numbers I previously provided, as I said, were drawn from data of Q4 of 2022. The main change from that heading into 2023 was the 1st of January reinsurance renewals. And I'll come on to some more detail there, but the pricing of reinsurance has increased, which is a cost to insurers. All that goes to say, although the market is improving, insurers are still cautious, and in this climate, they're reviewing their exposures carefully, and this can be how much limit they put out, the level they attach, and what sort of areas they're willing to write risks in. As I said, just to provide a little more detail on the reinsurance renewals, because this is going to be the main factor that has changed since those rate increases that I previously provided. Reinsurers, as I said, buy insurance themselves, and they do this for a number of reasons. It allows them to deploy larger limits, it helps them smooth out results, and particularly it adds protection for catastrophic events. The reinsurance costs essentially are passed on to the insurer and therefore back through to the client. And the main exposure for the reinsurance side that's been affected recently is property reinsurance, and that's on a cat level. So the 1st of January this year was one of the most challenging reinsurance renewals there's been in a long time. For North American property reinsurance, we saw rates increase by 40 to 60%. Luckily, this doesn't mean there's a direct correlation, and that's what you'll see your insurance cost increase by, but I think it's important to highlight that change. On the casualty side, definitely lower numbers than the property, but we saw 10% as the average rate increase on that side, which again is an increase in cost to those insurers. Through 2022 as well, the reinsurance capacity and the capital available did shrink, and this is related to the investment returns and their use of capital behind the scenes. Here, essentially, what's happening is that there's less supply of reinsurance, and that means again there's an increase in cost, and reinsurers start to evaluate how they position themselves and where they attach. All right, so I'm conscious that so far I've been talking at a very high global level and breaking down into some of the trends in Canada, but I think it's important to highlight why we start at this level. So lots of insurers used on the programs that you'll see in Canada and for social housing operators are global insurance companies, sometimes headquartered in Europe and the United States. When they're looking at what they need to achieve globally, they are looking at their global results, and that's why it's important we consider some of these factors. As I said, weather and climate continue to dominate the loss results of those insurance companies, and that's particularly why we're seeing larger increases on the property insurance at the moment. It's over the last few years, there's been a shift with the insurers, the direct insurers, from generating money and getting returns through economic investment to underwriting profitably on their own, standing alone doing that. So what they're trying to do now is really focus on making sure the premium they take in is adequate for those risks, and they're not going to lose money because the claims paid out are going to be larger than the premiums they take in. It's also key to highlight the UK insurance market. That's not just because I'm from there or this accent, but it's a global hub of the insurance market, and often has an influence of what's happening in Lloyd's and in London generally, has a knock-on effect to what we start to see throughout the world and in different regions from that. Lots of the insurance companies we use and access in Canada have links to Lloyd's of London and reliance on that capital. I also think that, with Lloyd's, it's important to highlight that it often dictates whether it's a hard or soft market. We talk about hard market insurance and being restricted capacity and increasing prices, and the soft market being the other way around, when there's a large supply of insurance, large amounts of capital, and decreasing pricing. As you can see from the 21 quarters of global pricing increases, we're in a hard market at the moment where the price is being driven up. And as I mentioned before, the reinsurers for Canadian insurance companies are often global insurance companies, and those reinsurance rates I pointed out have had a knock-on effect of the cost to insurance companies. So then to again look at what we're seeing and what we're expecting in the Canadian market. There is still limited capital available, and the underwriting continues to be conservative. So the conservative side of the underwriting is a scrutiny on how insurers deploy their capacity, and that's the amount of capacity they put out, where they attach, which you'd see in the form of what the deductibles would be, and also they'll look at which sectors they're willing to write, and if they're seeing any higher risk sectors, they'll start to review what they do there and if they continue to participate. Again, within Canada, we're expecting to see those Canadian insurers follow the global trends, and again, we're seeing in certain areas insurers are starting to write more business, which is fantastic, but there's still a number of areas where they have concerns. And I'll come on to the details of a few of where there's challenging industries and where there's industries that we're starting to see insurers write more business. So as we run through the different industry segments, again, I think what we're seeing in Canada or in the domestic market is a reflection on what's happening on a global level there. I don't want to sound too doom and gloom through this whole presentation, so I think it's important to highlight that there are some industry segments that insurers are looking to participate on, and that competition's creating good results in terms of coverage and pricing. Manufacturing risks is a risk that lots of insurance companies are looking to participate on, particularly if it's Canadian risk only. So if there's limited cross-border exposure, insurance companies are very happy with that. The reason they don't like high percentages of US sales is it's still a much more litigious environment down in the US, where they're seeing high rewards, particularly on the liability side. Small construction risks, there's also a number of markets there who are willing to write those construction risks. There are factors the insurers would consider around what exposure and capacity they want to put out, but that's again why we're starting to see on the smaller risks where insurers are able to cover that risk individually, some positive results. If there's small businesses, again on a similar idea, we're starting to see good competition. And the reason I put proven track record here is insurers like to be able to see a history of how the company's operated, and they'd be more hesitant around startups and new businesses. Generally, and this again fits in with what we've shown through the global side, insurers are happier to write risk with higher proportions of liability exposure rather than property. And again, on the property side, one of the issues we run into in British Columbia is insurers have a real concern around their catastrophic exposures. Unfortunately, in BC, we're in an earthquake zone, and there's also various flood flood exposures. But if the insurers can model those and get their head around them, there are some opportunities to deploy limited capacity there. So there are definitely improvements, and that's where we're starting to see the average rate increase start to come down, but there's still numerous challenging industry segments. I think with this, the multi-residential portfolios is particularly relevant for those listening in today. So under that would include social housing, senior care, assisted living, independent living, as well as apartments and condominiums. This continues to be a challenging exposure for insurers, but there's a limited number of insurers willing to write this. Healthcare is similar at the moment, that there's limitations on how many insurers are willing to write this, as they see it as a higher risk profile. Running through the rest of the points there, I think they'll be less relevant for today's call, but key to point out. So architects and engineers, transportation, frame construction, where there's limited capacity available, public sector risks, vacant and non-tenanted risks, and cyber all continue to be areas where insurers are very cautious and careful about what they're doing at the moment, which essentially is equating to increases in prices. The final bullet point I have there is just that any accounts with claims severity or claims frequency are going to have, again, more scrutiny coming through. So the average percentage rates we were talking about earlier, a lot of those will quickly go out the window on an individual account if there is a poor loss record. So it's important to highlight that and just reconfirm that it is average rate increases I've been talking about up till then. So this leads me on to, from that background of what we're seeing in Canada, what can you expect running through 2023, and relating this to, for those in the MARSH BCMPHA renewals in July, what do we expect? So, as I said, it sounds there's a lot of challenges and headwinds that I've mentioned, but the insurance market is trending in the right direction. When we're looking at those overall increases, they are much lower than they have been for the last few years. In Canada, we're going to continue to see the domestic insurers follow what's happening globally. And I think of particular importance for your risk this year is the consideration of the CAT exposure, particularly on the property side. So the insurers are carefully looking at earthquake zones and remodeling those in terms of what they say is the risk profile, as well as how much exposure they have in those areas. And the same can be definitely said for flood and wind. If there is poor account performance, thinking back to the poor claims record, or in high risk sectors, and unfortunately social housing, healthcare, assisted living, independent living do fall under those, there is going to be a lot more detail required from insurers as they look to make sure they're happy with how they're exposed and what those risks are. So with those challenges, I think it's important to set out what we look for in the program as we come up to the 1st of July. So one thing is to understand the sector you operate in and what those risks are, and make sure that with those risks that can be insured, there's the right amount of depth and coverage that's needed. So providing the right limits at the right attachment points and keeping as broad cover as is available. Obviously, pricing links in very closely with those points. I think it's particularly important, as it's a high risk section, high risk industry, that we look at the risk management process. And I'll come on the last slide I have is around risk management and loss controls. But when we're looking at the program we have, what we're looking to do is work with insurers to demonstrate an improvement of risk. This should help you individually, but also as a portfolio should long-term improve the loss ratios and a number of losses to help us negotiate the best terms possible. And so it should have the double benefits along that side. The risk management focus on this program really kicked off in 2018. This is looking at short and long-term risk management for the BCMPHA program, and working alongside MARSH engineers and loss control experts, as well as insurers we have on the program, to make sure we're improving the risk in all the ways we can. So I think also as we come through the renewals and look further ahead. So sorry, it says 2022, but looking through 2023 and beyond, what we're really looking to do as well is see what risks are emerging in the industry and where new solutions can be found. So we've got a number of insurers on our program at the moment who provide a good amount of stability and have been good partners. What we want to do though is to continue to understand how the risks are evolving and what solutions we can provide and work with insurers to provide going forwards. And I think that's a really important point that links, as well as the short-term pricing, to understand a partner who, as risks change, and that may be over the last few years seeing the pandemic or a changing economic environment, that the insurers aren't withdrawing or changing terms quickly at that, but trying to create a certain amount of consistency going forwards. So if I leave with the last slide to quickly cover loss control. As I mentioned, there's a short and long-term view to this risk management program. The short-term view may be more towards housekeeping. The longer-term view may be towards capital investment or changes in operations that take time to implement. MARSH has various engineers and loss control experts who I think can provide a benefit of through site inspections, and these could be virtual, they could be new locations you have or existing locations on the program. But MARSH can work alongside the housing operators to help paint a picture of the risk profile and highlight areas that can be improved, which are the recommendations that are set out. I think where this is really impactful is hopefully it has the direct benefit of improving the risk of your current operations, but where we're really looking to work with insurers as well as the secondary benefits of seeing how this can hopefully translate to improved insurance terms and improved insurance pricing as well. So at the bottom there, I've just mentioned some of the categories of recommendations. At the moment, I don't think there's a new category that's emerging that's different to what we've seen in previous years. But I think it's important to highlight it's still often the same categories that are being unearthed. So water damage mitigation continues to be a real area of focus. Water damage is of real concern for property insurers, and there are improving mitigation systems that are available. And this is something that's looked into very carefully on any site visit. The other points are the electrical maintenance, general maintenance, and also anything to do with life safety and general safety throughout the operations. I think with the loss control side, I think it's worth highlighting that for anyone in the program at the moment, over the next few weeks, you'll start to hear the correspondence from us requesting renewal information for the 1st of July renewals. But alongside that, there'll continue to be follow-ups on any loss control recommendations, it's maybe looking at new site visits, or it may be looking at previous recommendations to see what's happened and how the risk may have changed since those recommendations were set out. So I think I've just about managed to keep this to sort of 45 minutes, but before I get on to any questions, I would just like to say thank you again for all joining. I appreciate it's a high level overview of the insurance market and the insurance programs, and the risks are individual to individual operations. We're always very happy to have conversations and go into more details. But yeah, as I said, anyone in the current program will be in touch over the next few weeks, and I'm very happy to take any questions and answer anything. And if you do want to contact me after this, if anything comes to mind, please feel free to reach out. Yeah, I'll check with Courtney as well, but I'm happy to share the presentation slides as well for anyone who would like them. But with that, I will open it up to questions, and I'm afraid I can't see if there have been any in the chat because I've been sharing my screen.
I believe there's one, and apologies if it's already been answered, but there's a question, does liability cover only the primary tenant, or does it also include like other family members, including children and other guests that might be responsible?
So for liability, there's two sides. So under our main program, we have the general liability cover. So for the operators, this provides any third party any injury to them, and that is very broad. So this is anything outside your employees that cover would be for. So that's the third party bodily injury. I'm not sure if the question may be also related to the liability cover under the tenants insurance program. Again, if they purchase that cover, it's for third party bodily injury that the tenants may cause. So if they're held responsible for damage to a premises and someone's injured in that as a third party, that's where the $1 million limit for under the tenants program would be available.
Yes, sorry. It's actually it was myself who asked the question. So I work for affordable housing provider, and when I try to explain how insurance works for the tenants, I'm not really sure what I'm supposed to be saying. I pretty much just give them the brochure and apply it themselves. But if I could give them more information, like when they apply for insurance and this $150, does it only cover the tenant who signs the agreement, or also their family members that are going to be residing in the unit? Or if they invite certain guests that can do damage to the unit, will that damage be covered?
I believe, and I will need to double check this, but I believe under that program that it's essentially for all those living in that, if it's an apartment, so it can be the group members of the family that it provides cover for. So on the first party piece, the contents, it can include everyone who is living there for any of their contents, and as I said, that can be for water, smoke damage. It also provides protection if their contents and their possessions are stolen or vandalized. And then again, if they're responsible for damage, and that could be to the premises itself or others, that protection is for all members there. So yeah, it would be for both.
Okay, thank you. So if they invite the guest and the guest trashes the unit, like, I don't know, burns it down, whatever, would this still be covered, right? Like, or
Sorry,
this is how
hear that very well.
So if they invite a guest or a family member and something happens and the guests, a guest burned down the unit, so it's not a direct responsibility of the tenant, but a guest of theirs is responsible for severe damage of the unit, would the insurance cover the tenant in this case?
I can check for you on that. I'm not actually sure if it's a guest, whether there is or not, and I'd want to double check the policy rather than do that. But I'm very happy as well. If you wanted to get in touch, I know it's we've got a team that specialises in this tenants insurance, but I can find that answer for you. I'd rather not guess it on the call.
Sure, sounds good. Thank you so much.
I'm not seeing any more questions in the chat, but I know some. Oh, Rod, did you have one?
No, I was just if I unmute myself, yeah, there we are. No, I was just interested in getting the slide deck if it's possible from Rory. Great points, Rory. English accent. I'm thinking London.
It's a very good guess. Yeah, southwest London. So it's quite a big spot.
Yeah, I started school in Saunderstead.
Oh, right.
South of Croydon.
Yeah, so it's been a few years across here, but yeah, I'm very happy to share the deck as well. And if there are any other questions that come up, obviously very happy to have conversations around those. And I think as well for the program, it's important to highlight, as you know, we'll start to have more of an idea of where the rates are looking over the next few months. We've already started negotiations with insurers for those 1st of July renewals, but we're not yet at the stage of having the actual sort of average rate increases for the program.
Yeah, it's problematic trying to predict anything these days. There's just too many moving pieces.
Yeah, there's a lot of uncertainty out there for sure, and
well, that's generating the uncertainty, right? And you're seeing the markets, you're seeing it all over the place, and I can understand why it's tough to predict any of that.
Yeah, it is, and I think at the moment it's some good guidance we can provide with those numbers, but as I also mentioned, it comes down to individual risks and specifics as well, which I think is yeah, you know, in a presentation like this, it's hard to get down into the individual specifics of one risk, but yeah, I think hopefully paints a bit of a landscape of what's currently happening and what factors are being considered by those insurers.
Yeah. Well, thank you, Roy, for your presentation. Well done.
Were there any other questions?
I'm not seeing any being put in. I popped your email into the chat in case folks wanted to follow up. And then just restating as well that this session has been recorded and we will be posting the recording on our website, on our YouTube, as well as emailing out a link to everyone who's here, as well as everyone who registered but wasn't able to join us this Tuesday morning. So it'll be all available if you would like to rethink or have questions or reach out again. Giving folks one last shot if there was any burning questions lingering. Feel free to unmute or pop in the chat, but otherwise just wanted to thank Rory for walking us through all of that this morning, and for all of you folks for joining us this lovely sunny morning, and hope to see you in future online learning events with our team.
Brilliant. Thank you very much, everyone.
Thanks, everyone.